Assalamu alaikum. This is my first video on business combinations. Any investor will invest in a company only if he expects to get returns on his investment. An investor is satisfied not only by receiving returns, rather, he expects maximum returns. The top management's primary goal is to grow so that they can hold their investors. There are two ways of growth and expansion. One is to invest some portion of the annual profit and increase the production, thereby sales, but this will be a very slow growth. Another method is to grow overnight at a very fast pace by business combinations. In this video, we are going to talk about what is business combination, historical perspective of business combinations, nature of the business combination, asset acquisition and stock acquisition, classification of business combinations, takeover premiums, advantages and disadvantages of business combinations, defense tactics, and avoiding the pitfalls before the deal. But before I start this session, I would like to thank Nabiha Khan for her dedication and hard work in preparing these slides. A business combination occurs when the operations of two or more companies are brought under common control. The impact of an acquisition is far reaching and affects many different companies and individuals. A business combination may lead to rise in the stock price. Employees may express their concern as one of the objective of combination is to cut down the cost. This may lead to thousands of job cuts. Customers may worry about the prices they have to pay after the combination. Suppliers to the merged companies are also concerned about the business combination, as the merged company will be in a better bargaining position, and this will put the suppliers at disadvantage in terms of setting prices. Growth through mergers and acquisitions has become a standard in business throughout the world. This has been possible because of cheaper credit and global competition. Let us now talk about the historical perspective of business combination. The history of business combinations can be broadly placed into three time zones: 1880 to 1904, 1905 to 1930, and then 1945 till date. During horizontal integration, the purpose of business combinations was to have monopoly power. The companies involved in such combinations were from the same industry. Vertical integration was the period of World War I. In addition to the human loss, there was a huge financial loss also. So the government encouraged business combinations that integrated operations, reduced cost and monopoly, discouraged price competition, standardized materials and parts to minimize the cost. This is called vertical integration, as this involves the combination of a company with its suppliers or customers. Conglomerate merger period started after the World War II. During this period, the government has limited the combinations of firms in the same industry. So mergers took place in diversified companies having minimum of similarities. The motive of such combination was to diversify business risk by combining companies in different industries, or to create value by lowering the firm's cost of capital. Next, let us talk about the nature of business combination. A business combination may be of two types: friendly or unfriendly. In a friendly takeover, the board of directors of the combining companies mutually agree on terms of the proposed combination. Then the terms of combination must be approved by two-thirds or three-fourths of the shareholders. In an unfriendly combination, the board of directors of the targeted company resist the combination. Let us now talk about the two ways of payments to acquire a business. A company can be acquired either by asset acquisition or stock acquisition. In an asset acquisition, the firm must acquire 100% of the assets of the other firm, and only the acquiring or new company survives. The books of the acquired company are closed out and its assets and liabilities are transferred to the books of the acquirer. In a stock acquisition, a firm may obtain control by purchasing 50% or more of the voting common stock, or possibly even less. In case of stock acquisition, the acquired company and its books remain intact and consolidated financial statements are prepared periodically. In such cases, the acquiring company debits an account investment in subsidiary rather than transferring the underlying assets and liabilities onto its own books. The advantages of stock acquisition over the asset acquisition are lower total cost, direct formal negotiations with the acquired firm's management may be avoided, the acquired firm exists as a separate legal entity, the liability is limited to the percentage of stock acquired, greater flexibility in filing individual or consolidated tax returns. Finally, regulations pertaining to one of the firms do not automatically extend to the entire merged entity in a stock acquisition. Let us now talk about the classification of business combinations. Business acquisitions can take three different forms: statutory mergers, statutory consolidations, and stock acquisitions. Let us first talk about statutory mergers. A statutory merger occurs when two corporations join together, but only one of them continues to exist as a legal entity. In case of statutory merger, only one company acquires all the net assets of the other company through an exchange of stock or payment of cash or other property or issue of debt instruments or a combination of these methods. In case of statutory merger, the acquiring company survives, whereas the acquired company ceases to exist as a separate legal entity, although it may be continued as a separate division of the acquiring company. Let us talk about statutory consolidation. A statutory consolidation results when a new corporation is formed to acquire two or more other corporations through an exchange of voting right. The acquired company then ceases to exist as separate legal entity. For example, if C company is formed to consolidate A company and B company. Let us talk about stock acquisition now. In case of stock acquisition, the acquired company remains intact as a separate legal entity. When the acquiring company acquires the controlling interest in the voting stock of the acquired company, a parent subsidiary relationship exists. Next, let us talk about takeover premiums. Takeover premium is the difference between the market price of a company and the actual price paid to acquire it, expressed as a percentage. The premium represents the additional value of owning 100% of a company in a merger or acquisition. There may be several reasons to pay high premium, like availability of relatively cheap credit for merger and acquisition. They may have private information about the target firm suggesting that it is worth more than its current market value or has assets not reported on the balance sheet, such as in process research and development. Companies are desperate to boost earnings. Let us now talk about advantages and disadvantages of business combination. External expansion through business combination has several advantages. First, operating synergies. Company combining with another company is advantageous in several ways. The operating unit already exists, so you need not to establish one. Workers are experienced, so there will be little or no need for training, and the productivity will be high with minimum wastage. Suppliers are already there. Production and distribution channels already exist. Business combination can be of two forms. It can be a vertical merger, a merger between a supplier and a customer, and such combinations lead to elimination of cost like negotiation and bargaining cost. The second form of business combination is horizontal merger, a merger between competitors. Such combinations lead to elimination of duplication and unnecessary cost like combining of sales force, facilities, outlets. Then another advantage is that the company can compete effectively in the international market. As already explained, growth is the primary goal of any company. And one way of expanding it is by entering new markets and even international markets. Prior to expanding its market, the company must ensure that suppliers and customers are readily available. Entering the new market will also help in reducing cost and smoothing cyclical operations. Yet another advantage is financial synergy. I would like to explain this with reference to two aspects. First, taking advantage of income tax laws, and second, taking advantage of acquisition by debt. Business combinations help to take advantage of income tax laws. For example, the acquiring company can acquire the company at a cheaper cost if the company is generating a loss. Not only this, when the acquiring company files a consolidated tax return, the tax liabilities will be reduced by the losses of company acquired. Second, the acquiring company gets the advantage of tax gain if the acquisition is financed by debt, as payment of interest on debt is tax deductible. The tax implications are a driving force in merger decisions. There are other advantages of business combination as well, like increased flexibility in operation, increase in the firm's debt capacity, as a combined firm will have more assets at their disposal, more effective utilization of resources, as the combined company can eliminate inefficient workers, equipments, etc. More competition, more protection from the competitors. Let us talk about the disadvantages of business combinations. Business combinations may lead to inefficient management control of a large organization. It may be difficult to sustain at the time of recession. It may lead to divestitures, that is, selling off subsidiary business interest or investments. Difficult to pay off debt during decreasing economic activities. Suboptimal allocation of capital. Such situations may arise as the company is reluctant to eliminate jobs because of social or governmental pressures. Let us talk about the defense tactics to avoid acquisition of business. The target company has several defense tactics to resist the combination, and we will talk about some of them. First is poison pill. A poison pill allows existing shareholders of the target company the right to purchase additional shares at a discount, thereby diluting the ownership interest of a new hostile party. Green mail. In case of green mail, the target company repurchases its shares at a premium. The third tactic may be white knight or white square, and in this case, the target company encourages a third firm more acceptable to them to acquire or merge with the targeted company. Pac-Man defense. Offense is the best defense. In this case, the target company attempts an unfriendly takeover of the would-be acquiring company. Selling the crown jewels. Another tactic is to sell off the crown jewels, thereby making it less attractive to the would-be acquirer. Finally, leverage buyouts. In this case, managers and third-party investors purchase the controlling interest in the target firm. Finally, let us talk about the pitfalls to be avoided before the deal. First, be careful in interpreting any percentages presented by the selling company. For example, the seller may be operating below capacity, say at 60% of capacity, but the available capacity may be for a product that is unprofitable, while the desirable product line which the acquirer wishes to expand is already at capacity. Don't neglect to include assumed liabilities in the assessment of the cost of the merger. Watch out for the impact on earnings of the allocation of expenses and the effects of production increases, standard cost variances, LIFO liquidation, and byproduct sales. For example, a firm that is planning to be acquired may grow inventory levels in order to allocate its fixed cost over more units, thus decreasing the cost of goods sold and increasing the bottom line. Note any non recurring items that may have artificially or temporarily boosted earnings. In addition to non recurring gains or revenues, look for recent changes in estimates, accrual levels, and methods. Finally, be careful of CEO egos. So, this completes the discussion on Introduction to Business Combinations. I hope it benefited you. Remember, questioning is the ability to organize our thinking around what we don't know. If you have any question regarding the topics covered in this video, please send me an email or put your question in the comment box and inshallah I will reply you back. Happy learning.